So for this mock exercise, we're going to take a look at merchandising operation. And this question takes us through essentially 2 points of view, one from the seller's point of view and one from the buyer's point of view. We're looking to see how does each party record a sale or record a purchase and record a purchase and sale transaction. So we're going to take a look at this question. So this question, both Duval and Pell incurred the following merchandise transaction in June. So on June 10th, Duval sold 10,000 merchandise to Pell. And it says in terms 110 net 30. And what that means is if Pell pays Duval, so if the buyer pays the seller within 10 days, they get a 1% discount. Otherwise, it's due on 30 days, so it's net 30 from the date of sale. And it says FOB shipping point. It means as soon as the goods leave the warehouse of Duval, it is Pell's responsibility. So as soon as the goods leave the warehouse of the seller is when the seller can recognize revenue. On the 11th, freight costs of $500 were paid by the appropriate company, and in this case, who would be paying for that? Because it's FOB shipping point, it would be the buyer. In this case, the buyer would have to pay for the shipping cost. Then on the 12th, it says Duval received damaged goods returned by Pell for credit. So a couple days later, the buyer was able to examine the goods, and they realized that there were a whole bunch of goods that were damaged. The goods were originally sold for $500. The cost of return merchandise was $375. And this is an important statement: is the merchandise was not returned to inventory. So basically, it was trashed. So it wasn't returned, which means we don't record an increase in inventory because those goods are not available for sale. On the 19th, Duval received payment from Pell on the 19th. And it's important to know that because we sold it on the 10th, and 9 days later we paid it, which means that they qualify for the 1% discount because it was paid within the 10-day period of the discount. So Part A asks us to prepare the journal entries for each of the 4 transactions in the books of Pell, the purchaser, assuming that the perpetual inventory system is used. And Part 2 of that first requirement says assume that the periodic system of inventory is used. Part B of the required asks us to prepare the journal entries from Duval's point of view, the seller's point of view. And again, assuming that the seller has kept a perpetual inventory system. And Part 2 of B says assuming that they used a periodic inventory system. All right, so let's do this question. So the first part I would like to do is I want to do it from the point of view of the purchaser. So that would be Pell or Pele. Okay? Now what I want to do is I would like to do a side-by-side comparison. So the side-by-side comparison says, assuming they use a perpetual, and this one is a periodic inventory. So the first part says that they purchased $10,000 worth of merchandise. So under the perpetual inventory system, on June 10th, they will record debit inventory, 10,000, credit accounts payable, I'll short form it as AP, 10,000. Under the periodic inventory system, their entry is going to be debit. Instead of inventory, they're going to debit purchases and credit accounts payable. Okay? So it's credit purchases. So what I'd like to do is highlight the differences in terms of what account to use, depending on which system, which accounting system we use, either perpetual or periodic. Now, the June 11th freight cost of $500 was paid by the appropriate party. In this case, because if it's FOB shipping point, Pele, the purchaser, is responsible for that particular charge. So we're going to debit on June 11th. We're going to debit, now in this, because it's perpetual, we're going to debit inventory. Credit, again, in this case, it's cash because we paid it, right? Whereas under periodic inventory, we're going to debit transportation in or freight in. $500, a separate account, and we're going to credit cash. Okay? On the 12th, it says Dorval received damaged goods returned by Pele for credit. The goods were originally sold for $500, and the cost of the goods merchandise return was $375. Now this is from the buyer's perspective. So on the 12th of June, we're going to debit accounts payable because we returned it. It's $500, and we're going to credit inventory. Whereas for periodic, we're going to debit accounts payable, but we're going to credit an account called purchases, returns, and allowances. Okay? And on the 19th, all was paid. And again, we talked about this earlier. We need to be mindful of the number of days, because in this case, it's only 9 days when they paid it, which means they qualify for the 1% discount. So the total liability is $10,000 minus the $500, gives me the $9,500, times the 1% discount, gives me $95. That's the discount I need to account for. So I'm going to debit accounts payable for $9,500, because that's much I owe. I'm going to owe $10,000 less the $500, so $9,500. So that extinguishes the debt. I'm going to credit the cash. And what's the cash amount I'm going to credit? It's going to be the $9,500 less the $95, which gives me $9,405. The remaining credit goes to inventory. Notice how every adjustment to the purchase, whether it's a return, whether it's a discount, all goes to inventory. That's the perpetual inventory system. Whereas under the periodic system, we have a separate account. In this case, we're going to debit accounts payable for the same amount, $9,500. We're going to credit cash for the same amount, $9,405. That doesn't change, but the remaining $95 we're going to credit to a purchase discount. Okay, so remember, under the periodic inventory system, we have separate account for purchases, that's gross purchase. We have a separate account to capture purchases, returns, and allowance, and purchase discount. Both are what we call contra account to the gross purchase to come up with what we call the net purchased. Then we're going to add freight in or transportation in to come up with cost of goods purchased. So that's part and parcel with the periodic inventory system. And we need to showcase the separate components of that under the cost of goods sold calculation. Whereas the perpetual inventory, if you notice, any adjustments to inventory, any adjustments to the purchase goes directly to inventory. So everything goes to inventory. Now, we're going to look at it from the seller's point of view. And the seller's point of view, the company's name is called Duval. And again, I'm going to split the two sheets, assuming Duval uses the perpetual inventory system versus the periodic. So let's go back again. Now we're looking at it from the seller's point of view. So Duval sold 10,000 merchandise to Pell. The merchandise cost Duval $7,500. So under the perpetual inventory system, Duval's going to record debit accounts receivable, 10,000, credit sales, 10,000. And because they're doing a perpetual inventory system, we're going to record immediately the cost of goods sold. So it's constantly updating. Cost of goods sold, and we're told it's $7,500, and we're going to credit inventory. Okay, so under the perpetual inventory system, the inventory is constantly updated, each sale and each purchase, so that at the end of any given accounting period, we can determine the total inventory at that point in time. Whereas under the periodic inventory system, you'll see that on June 10th, we're going to debit accounts receivable, credit sales for 10,000, but we have no corresponding entry to update the cost of goods sold and inventory. Why? Because under the periodic inventory system, the cost of goods sold and adjustment to inventory only happens at the end of the accounting period, and it can only be derived once the company does what we call an inventory count. The inventory, the company has to count the inventory remaining so that they can back it out of goods available for sale to come up with cost of goods sold. So that's the difference. Is under the periodic inventory system, a company cannot prepare and calculate cost of goods sold unless they do a physical count. Whereas under perpetual inventory, they can figure out the cost of goods sold because it gets updated every time there's a sale. So let's look at the second journal entry. It says on the 11th, freight costs were paid. In this case, because the freight cost was, if the sale transaction was FOB shipping point, the freight cost is the cost of the buyer. So from the seller's perspective, there is no entry for freight costs, right? And that is true for this one too. So there's no entry for freight cost. The 12th, June 12th, what happens is there were some returns. Now, if you notice here, the return was made, and the return was 500. So from the perpetual inventory's perspective, we're going to debit sales, returns, and allowance. This is a contra account to sales. $500. We're going to credit accounts receivable $500. Normally, we would have a corresponding inventory entry. We would debit inventory for the cost of those goods returned and credit cost of goods sold. But because of the fact that these inventory were damaged and they were not returned in inventory, there is no secondary entry. In other words, we don't reflect the inventory going back, the goods coming back into inventory, because those goods were not, right? They were damaged, so they will not go into inventory. Whereas under the periodic inventory system, there still would be a debit to sales, returns, and allowance for June 12th, right? And credit accounts receivable. But there wouldn't be any entry at all until, again, at the end of the year when the inventory is counted. And on the 19th, June 19th, finally a payment was made. And again, in this case, Pelly, the purchaser, was entitled to a discount. So once again, we calculate the discount the same way. So we're going to debit cash for the $9,500 less the discount, and we already calculated that discount. We are going to, right, debit the sales discount, which is a contra account to revenue of $95, and we're going to credit accounts receivable for the gross amount $9,500. And of course, this is the same for under the periodic inventory system. Okay, thank you.